Hi all and welcome back to another episode of the ICIS Energy Foresight podcast. We are recording this on March the 11th, the 12th day of the US-Israeli attack against Iran. And the IEA member nations just agreed to release 400 million barrels from their strategic oil stockpiles. Just to put it into context, it's the largest ever IEA release since its foundation 50 years ago, exactly when the first oil crisis hit the world. Brent, as a consequence, is now trading below $90 per barrel, and also TTF has fallen to roughly 48 euro per megawatt hour after the record high of like 2 days ago. In this episode, we are slightly changing the format, and we want to give you full access to our team of experts. 2 days ago, we had a webinar for ICIS customers, and we talked about the impact of the current war in the Middle East on oil, gas, and chemical markets. So we're gonna provide you different snippets from that webinar with the idea of trying to frame a bit what's going on, what are the implications for the markets we cover, the markets that you operate in, and obviously trying also to connect the dots across markets, both energy markets and chemical markets. But let's start from the oil market. In the first section, AJ Palmer walks us through what's at stake for the oil market and helps us frame the scale of the current situation.
Around a third of global seaborne crude flows pass through this narrowest of straits, and that's a total of around 15 million barrels per day of crude passing through Hormuz. This is Middle Eastern supply, the vast majority of which comes from Saudi Arabia, but of course the UAE, Iraq, Iran itself, and others also supply oil via Hormuz. Which countries are the main recipients of this oil? Well, almost all of that oil that passes through the Strait of Hormuz goes to Asia. China in particular is the main recipient, including almost all of Iran's roughly 1.5 million barrels per day of crude exports. Japan and Korea are also heavily dependent on crude passing through the Strait, with almost 90% of Japan's crude being sourced from the Middle East, while India depends on flow through the Strait for just under half of its crude imports too. So it is clear here that Asia is the most impacted region, but given the globally interconnected nature of oil markets, the knock-on consequences will affect every single region globally. So what about bypassing the Strait? We know that Hormuz is critical for oil flows. Do we have alternative routes for oil transit instead? Well, there are pipeline alternatives to the Strait that Saudi Arabia and the UAE have access to, but these pipelines do have capacity limitations. And even if those alternatives are fully utilized, we estimate that up to 10% of global crude supply will eventually need to be shut in if the Strait is not reopened.
Thanks, AJ. And when we compare the reaction of gas prices to the conflict, we can see how both the TTF and the AX have felt the consequence of the stop of the Qatari production and the stop of the export from the region. That effect was definitely bigger than what the oil market felt. Adcox went into that and trying to articulate and explain the details in terms of which countries are more exposed to the loss of the Qatari LNG and what that means for the global LNG market. Also trying to look at different scenarios in terms of the possible duration of the conflicts, 4 weeks, 12 weeks, or even longer than that. But please, Ed, over to you.
We're now almost exactly 1 week on from Qatar LNG's confirmation of a full production stop at its Ras Laffan plant. That's the largest export facility in the world that holds an 18% share in global supply. So if you add in the impacted supply from the UAE, United Arab Emirates, Das Island plant, we see 20% of LNG is now cut off from global markets. Now, there was a question in the chat about this, how the market would or could balance. Put simply, the LNG world as it is cannot balance without this supply. This is the second profound shock to the global gas supply market in the last 5 years after Europe moved away from Russian gas after 2022. We expect high energy market prices, high enough to kill off sufficient downstream gas demand for as long as this effective supply cut continues. Moving on to where we could go from here, we are coming to one of the weaker LNG demand periods of the year. So this is after the Q1 winter peak in Europe and East Asia, and before this seasonal Q3 hot weather demand drive in East Asia. So as of today, there is clearly no immediate prospect of LNG production and flows through Hormuz resuming. We also understand it could take at least 2 weeks to resume anywhere near full production from Qatar LNG and Ras Laffan after the restart. So if the conflict continues for 12 weeks, we see growing risk of escalating prices in both Asia and Europe and any other LNG buyers, including Latin America, for example. Seasonal demand, they're coming for their summer. And this is with Asia buyers really stepping in to replace this Qatari LNG. But in Europe now, LNG is 40% of Europe's gas supply. So European gas markets, they can't disconnect from Asia on price. They must and will remain competitive to ensure sufficient US LNG flows. This will impact downstream European markets, as Will has said. And we also expect more demand destruction and fuel switching across many Asian markets and elsewhere. Perhaps the biggest LNG concern is this risk of extended insecurity in the region and through Hormuz that continues for longer, for many months, and has a more profound impact across global economies. This would hugely increase next winter's gas supply security and trigger more price volatility. More than 20 laden LNG Qatari cargoes must go through Hormuz every week. There is no alternative route, unlike with the Suez Canal, where shipping markets have taken longer alternatives. And we mustn't underestimate the role of shipping insurance when we look at future vessels, even after Hormuz reopens.
Thanks a lot, Ed. And if we want to bring it back to Europe and trying to understand the implications of yet another gas crisis for the old continent, we've discussed this with Andreas, and Andreas walked us through what are the consequences for the European gas market of the stop of the Qatari production in the Middle East, and what are the countries that are more exposed in Europe, and what does that mean for the European refilling season in terms of the gas storage refilling season, which was already not showing the right price signals before the start of this conflict, and obviously is now fully exposed to a forward curve which is providing all the wrong signals to marketplace to actually start looking at refilling gas storage and complying with the storage regulations that the European Union just relaxed last year. Andreas, over to you.
So in European gas markets, the importance of Qatari LNG has been dwindling since 2019. So Qatar's market share in Europe has gone down from 37% in 2017 to only 8% last year. And this is mostly due to the growing overall LNG volumes in Europe in combination with increased availability of American LNG. Qatari LNG did hardly benefit from the reduced Russian gas deliveries to Europe, and new long-term contract deals were not really sealed because Qataris and Europeans could not they disagreed on the contract terms. In Europe, the exposure to Middle Eastern LNG is highest in Italy with a 32% exposure, Poland 25%, Belgium 17%. And this is due to existing long-term contracts. We have seen a pronounced impact across European markets. And this holds even for Britain and TTF, Netherlands, which are heavily exposed to LNG markets, although just a tiny share comes from Qatar directly. So whatever the direct volumetric exposure to Qatar LNG, all markets in Europe are affected by the stop of Middle Eastern LNG exports. And global energy prices rise. The competition of importers in Asia versus Europe gets more intense, and that translates into higher gas prices across the whole continent. With the length of the Hormuz closure being a key uncertainty, we have analyzed different durations and their potential price impact. Our gas foresight modeling suggests that markets are currently pricing in an assumption for around a 4-week closure of the Strait of Hormuz. At least that was the case last Friday. And if the closure was to drag on for longer, for 3 months, then we see a significant further upside risk to gas and power prices, with TTF gas prices potentially rising to over 85 euros per megawatt hour in the coming weeks. And the impact of gas on power prices is very unevenly distributed across European power markets, and that's given the differences in fuel mixes. So Italy, Britain, Netherlands, they are most exposed countries to the current crisis, given their heavy reliance on gas-fired plants for price setting. Whilst Germany, Poland, France, they can revert to coal-fired plants, to nuclear power, which are currently deep in the money and running near capacity. Another thing to watch is if the EU decides to lower the gas storage targets. So this could have an immediate bearish impact on both gas and power prices. Therefore, we've looked at those in more detail. So high gas prices are putting gas storages under pressure, as can be seen with seasonal price spreads, and these are important indicators for the profitability of gas storage. So at the moment, winter-summer spreads are deeply negative, as you see on the right the chart here, and there's no incentive to inject into gas storage at current prices. But in response to the market situation, the regulators, they may address these difficulties of refilling gas storage during the summer, and lowering the pre-winter storage target from 80% currently to 70% could dampen the initial price spike on gas markets. While many market players will be waiting as long as possible now to refill storage, the reduction in the target for next winter would give more freedom for storage levels to fall lower during the highest priced period. So this would be March to May. However, because storage still needs to be replenished ahead of winter, stronger imports later in the season lead to a summer injection rate and price pattern broadly similar to the current storage regime. So regulatory flexibility mainly smoothens short-term price peaks rather than fundamentally really reducing overall market tightness. So we could say increased short-term flexibility reduces immediate scarcity signals, but it materially weakens Europeans' strategic storage cushion ahead of the next winter. And this effectively lowers security of supply for the upcoming heating season. So it would shift today's price exposure into higher risks for the next winter.
Thanks a lot, Andreas. Super interesting. And we will obviously closely monitor the evolution, especially understanding whether there are changes that the European Union might implement. To close up, we had a very extended Q&A sessions during the webinar. Thanks a lot for all of you that participated, for sending all those interesting questions through. For practical reasons, we're not able to obviously go through all of those. We've selected one that was that hit probably was the top one question that came through. Jamie, I'll let you introduce that question and all our experts answered.
If the conflict were to end today, how long is needed for production and logistics, so shipping, etc., to get back to normal? Who wants to go first?
I mean, I can just touch very quickly on the crude and refining side of things. To restart shut-in oil wells, it's not as much of a significant undertaking as it is for refining. So, restarting oil wells is looking like a week or two, depending on the well, depending on the region, etc. Potentially slightly longer, just depending on what we're looking at here. Refineries fully shut down refineries take weeks and weeks to bring back up again and back to normal operation, potentially over a month. So it really does depend on what we're looking at in terms of the levels of shutdowns and what type of actual infrastructure is taken offline and in what way they are taken offline. But we're potentially looking at weeks and months to get back to steady state if we saw an end to the conflict tomorrow. We're not getting back to normality anytime soon, let's put it that way.
Just on chemical plants, it's very relatively easy to adjust the operating rate up and down of a chemical plant. So they can be changed within days. But if you completely shut down a chemical plant, that's a different matter. To get a shut down chemical plant up and running again, you're looking at 1 to 2 weeks or more, because you have to start the main units and then you have to start all the downstream derivative units as well. It's quite a complicated, time-consuming process.
Just to end quickly on, I mean, there was this initial news came out, it's around 2 weeks to restart Ras Laffan LNG. I mean, it's almost 80 million tons a year capacity. I would echo what AJ said about the complexity and scale of that operation. Though I did just want to make one point about Hormuz. I mean, in the end, it wasn't a blockade of Iranian ships. It was the shipping insurance market that basically meant LNG vessels didn't go through Hormuz, right? That was the critical point. The war risk insurance stopped being applied. So that, for me, is one of the big questions. The security going through Hormuz, even after the conflict ends, how shipping insurers react. That's something I think to watch very carefully. The LNG vessels, there's 800 in the world now. They can move around relatively quickly. They can restart going through Hormuz very quickly. But the question is the security, and how that security risk is managed is a big question as well.
We've got to the end of this episode as well. We've changed the format. I think everything that is happening on the market is very fluid, and we want to be on top of it. And as always, we are trying to provide you the best information and insight on the energy market. If you want to know more, and if you want to obviously would like to attend the next webinars, just reach out. We're more than happy to have you on and get your questions and inputs as well. As always, we are available at ICIS.com or just, as I said, reach out directly. And to the next episode. Bye.